Hi, I'm Pattu from freefincal. Today let's talk about which debt mutual funds should I choose to benefit from the interest rate hike. This is a question that many readers, viewers have asked me since the rate hike a few days ago. And so let's talk about some frequently asked questions. We have a series called FAQ at freefincal, and we have talked about several aspects of investing and personal finance. We have talked about index investing, systematic withdrawal plans, target maturity funds, etc., super top up health insurance, etc. So it's a series on frequently asked questions. You can take a look at that. So first question is, I noticed that even liquid funds and money market funds fell on May 5th. Why did this happen? I thought these funds are the least impacted by interest rate changes. Now, it is crucial for debt mutual fund investors to always remember that the NAV is linked to the market price of the bond. So now if you look at what is known as the yield curve, so this is basically a plot of yields, bond yields, and on the y-axis, bond yields on the y-axis, and different maturities on the x-axis. You can see it goes from 6 months, 1 year, all the way up to 30 years. Now, if you look at the yield curve, that is a plot of the yield versus the duration. 1 year ago, the yield curve was this one on the bottom most line. Then 1 month ago, the yields had more or less uniformly increased to this. All the yields across duration had increased to the middle line. And then immediately after the rate hike, you can see the jump in the yield. It just jumped up non-uniformly. If you look at the long-term segment here, the jump in the yield is quite small compared to this segment here in the middle segment, 3 years, 4 years, 5 years, 6 years, up to 7 years or approximately. That's where the jump in the yield was the maximum. The second highest jump in the yield was in the money market segment, that is in the short term, less than 1 year bonds. You can see the bonds, 6-month bond, the jump is a quite significant jump. This is greater than the actual long term segment. Now there are several reasons for this. One of the reasons in this context is that people who have been holding long-term bonds, about 10-year bonds, they have been expecting this rate hike, increase in interest rates for a long time. So gradually the yields in the long-term segment started moving up. When the bond yield moves up, that means the price of the bond comes down. That is, people are not willing to buy a long-term bond when there is a prospect of a rate hike, because when the rate is increased, then a newer long-term bond will have a higher interest rate. So people will not like to buy a old long-term bond and lock themselves into a lower coupon rate. So that's why the demand has gone down gradually, the price has gone down gradually, the yield has increased gradually. Whereas in the middle term segment and the short term segment, that did not happen as much. I mean, we can only speculate as to why it happened, but it's better not to worry too much about it. It just happened. Now, so what this means is that the demand versus supply forces in the bond market is different for different segments, and this is something that's crucial to understand, in addition to the fact that the NAV depends upon market price. So that's the reason why liquid funds and money market funds also took a hit. When the RBI increased the rate hike, immediately people holding short-term bonds, they demanded a new bond with a better coupon rate. They expected it to come immediately. So that is the reason why the demand for existing 6-month bond, 3-month bond, etc., suddenly fell down, and therefore liquid funds and money market funds also had an impact, and now it fell down. Of course, it will immediately recover. That is not a problem, but it's important to understand how things work. So I noticed that many gilt funds did not fall as much as constant maturity funds, or as much as I thought they would. Now, the constant maturity funds here are 10-year funds. The 10-year constant maturity fund will hold bonds close to that 10-year duration. So they are expected to take the maximum hit. But the gilt funds, they have the freedom to change the bonds they hold, I mean, as long as they stay within the gilts up to 80% of the portfolio. So gilt funds are essentially dynamic bond kind of funds. And if you look at ICICI Gilt, which I am invested in, it did not fall as much at all, and that's because they had enough time to prepare. And many dynamic bond funds as well as gilt funds changed their average duration. That is, they started buying more of short-term bonds and sold their long-term bonds, so the impact was typically lower. Should I now exit from my gilt funds? Now, if you are invested in a gilt fund for long-term goals, being fully aware of the risks, you can continue. There's no need for you to exit. But please understand that depending on how many future rate hikes there are, the NAV will fall further. There can be a couple of years of poor returns. Is this a good time to start investing in gilt funds? Now, this is only for people who want to opportunistically invest in gilt funds. That is, they want to tactically enter and exit depending on the position in the rate cycle and so on. Now, I would recommend not buying gilt funds at the bottom of the rate cycle, because buying the dip can be very frustrating. It can take months and years for recovery to happen. I had talked about a momentum based gilt tactical exit and entry strategy sometime back. I will update it soon. But if you look at that model, I just checked the data. If you look at that model has been saying sell from July 2021. And so I think if you go by that momentum based model, this is not a time to buy. This is only for those who prefer tactical play. If you have goal based investing, continue investing or avoid gilt funds, whatever is up to you. I am invested in ICICI Gilt as per my asset allocation and as per my goals, and I am going to continue investing in it. Now, should I choose a floating rate fund? Now, I had talked about this in a separate video earlier. Floating rate funds are complicated instruments. The demand and supply forces for floating rate bonds is separate. That's a different animal altogether, and it's better for investors to avoid such complicated products. If interest rates keep increasing from this point on, liquid funds and money market funds and ultra short-term bond funds will start to do gradually better and better and better. It is easier for investors to invest in a safe liquid fund or a money market fund than choose a floating rate fund or a ultra short-term fund. So there's no need for a complex product. They can just choose liquid funds or money market funds. So I've just answered the next question. What kinds of funds should I choose to get good returns in the near future? If the rate cuts keep if the rate hikes keep coming, if the interest rates keep increasing, I keep confusing rate hikes and rate cuts, I'm sorry about that. If the interest rates keep increasing from this point on because of different macroeconomic conditions, higher inflation, world problems, global problems with war, etc., supply demand of oil, etc., and so on, then, like I said, money market funds and liquid funds will start to do better. It's safer to simply invest in them. Will there be future rate hikes? I think the possibility of that is quite high, but it may not happen every quarter. We don't know when it will happen. It may take years for a rate cycle to pan out. So we can't exactly predict that. Will the stock market crash because of rate hikes? No, it will. The stock market needs an unexpected bad news for it to crash, or it needs an unexpected good news for it to suddenly move up. That does not happen. Everybody has been expecting a rate hike for a long time, and it's just that the timing was a little unexpected, but everybody knew it was going to come. So what could happen is that what is more dangerous than a crash or a bull run is a sustained sideways market where there's nothing happening, where there is neither good news or bad news, and the market keeps waiting at some level. It will move down by 1%, then move up by 1%, up and down and so on. Then you will lose, because of the time value of money, you will lose returns on your portfolio. That is quite possible to happen. Whatever it is, we recommend generally most investors should not engage in tactical play for both gilt funds as well as the stock market. It's better to invest as per your goals, and you can have a mix of both gilt funds and liquid or money market funds in your portfolio. Then overall your portfolio will not suffer too much. If the gilt funds returns are falling down, the money market liquid funds returns will go up a little bit, and they'll kind of balance out each. And so that such a balanced approach is enough at this point in time.